Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, July 22nd, 2019. In this video, let's take a look at the semiconductor sector. So what I'll do is go through the charts of the ETFs in this video, as well as the index itself. There's three main ETFs that track semis. That's SOXX, XSD, and SMH. So we'll look at all three. I'll start out here. You know what? Let's cover the other ones, and then I'll do most of my analysis on SOXX. Why? There's a couple reasons why. Number one is this tracks the SOXX Semiconductor Sector Index, and that PHLX has been around for years. I mean, I was, back in the 90s, I used to watch the PHLX trading, and it's, so there's a lot of chart history on it. And the other ones are ETFs that came along and, track some other index that hasn't been around as long. However, it's certainly worth keeping an eye on all of them. So we'll start out with the others, and then we'll get into the charts of both the ETF SOXX as well as the index itself. All right, so let's just start with XSD because their charts are a little bit different. They tell a little bit different story right now. What stands out to me in XSD, and really all the semis as a group, is they're very tradable. They're very trendy little suckers. I'm going to get to that in a second and show you all these micro trends. They're very strong, and they're almost always followed by very strong reversals. I'm talking about all these micro trends. Strong trend up. Nobody wants to short them because it's very powerful, and then a swift drop. Again, I'll get to that in a minute. I have some lines marked up on another chart. But as you can see, there are periods of consolidation like anything. But for the most part, the semis, like I said, are trendy little suckers. They're either, going near vertical up or near vertical down, and therefore there's a lot of money to be made if you get the timing right on these. So let's start out with where we're at right now, what the current technical posture is. So this is XSD again. That's the Spiders S&P Semiconductor ETF, and you can see, as I have it marked here, we had negative divergence at that last high. We had a short trade on the semis back then. And again, they trade well to the technicals. There was a pretty clean uptrend line to look at there. You had the negative divergence line right here, divergence on the indicators down below, and a very swift drop. And this is an example of what I was talking about. Straight up and then straight down. There's no effing around, if you will, on the correction for the most part. In other words, you don't break this and it's just going to move around. You can do that, but what I'm also get to is the steeper the trend line, and this holds true to just about any security. The steeper the trend line, usually the more swift the correction when it comes. This is a gradual, really much a normal trend line like what you might see in the broad markets. There was still a pretty impulsive correction afterwards, but again, you get these very steep trend lines like this, and you can see a near vertical plunge after the near vertical rise. And so that's where we're at today. We have this trend, and I think part of what happens is when you see these very powerful trends like this, it just breaks the will of shorts. Anybody that's trying to short the semis right now or has been recently, you haven't been any sell signals at least for a while. But if you're short the semis, that takes the gas out of your tank right there. This day after day, very strong advance. And I think that's what happens is it clears out short interest. And when you have a stock or a security or a sector with low short interest, that sets the stage for these waterfall sell-offs. When you have a very heavily shorted stock or ETF, what happens is once you break trend and the trend reverses, and uptrend reverses, you have shorts that come in and they take profits. Because I've always said this, of everybody out there, think of everybody in the world, all market participants that have money and the ability and the desire to trade in the markets. You might have somebody march out on CNBC and they just sing the most bullish song on the semiconductors, tell you why they're going up, why they're going to continue to rise. But that may be rhetoric. That investor may have all intentions to buy the semis if they're not already long, but they don't have to buy them. Something may change their mind. They may just talk a bullish talk and have no position. However, the only guaranteed buyers in any stock or security are shorts. Why? Because when you short a stock, you must at some point in time buy to cover that position. You have to close it out. You've shorted shares that you don't own, and at some point you're going to have to cover those shares either at a gain or a loss, or you may get a notice from your broker randomly. This happens. I've been quite a few times I've been short stocks and get a notice of failure to deliver or failure to locate the shares, meaning the broker no longer has shares to lend you, and you have to then close out that position, or they will do it for you. So that's what happens. So when you have a lot of shorts in a stock, they then tend to take profits along the way on pullbacks. When you don't have a lot of shorts, then you get those very swift drops till they finally get the short interest or the correction set in, and then followed by that rip. So I wanted to just kind of share the nature of the semis and these trends. And the thing is, you have to move quick. You have to see a setup, wait patiently. Don't get in early. Sometimes we do. I'm not perfect. There's sometimes I'll take trades early and I get out, and that's what stops are for. You don't get married to the trade, but you get ready when you start to see the setup forming. So right now, the takeaway is on XSD. You can see we had a divergent high there, a relatively small divergent high. The divergences from that point, even though we had a correction, they have continued to build. So this is just an extension from that same point back here where the divergences started, right here, back in late February, early March. They've continued to build. They're what I call unconfirmed divergence because we don't have a lower low in the PPO yet. It is trading below the previous peak high right there. I should say a lower high is what I meant to say. But in my book, I wait for that bearish PPO crossover like you had right here. You can see where the orange line crossed down below the white line. Why? Because that effectively put in a lower peak from the previous peak. These are momentum indicators, the RSI and the PPO. And as long as prices continue to rise, these indicators, as this one's pointing up now, will continue to go up. And that's why, to me, this is only potential, not confirmed divergence, because if it goes up much more, it takes out this previous peak, and then more importantly this initial peak here, and then you no longer have negative divergence. It's been taken out. So that's what I'm watching. So ideally, and I think this will all we'll have a good idea at the end of this week or early next week, because Intel, the largest semiconductor stock in the world, top weighted component of all these ETFs, they report earnings on Thursday after the market close. So one way or another, the semis are going to either gap up or down on Friday, and then once the market digests everything Intel has to say, not just their initial report, whether they meet or beat or fell short of expectations. That's not really that important. It could matter, but the more important thing is then what do they say on their conference call? What kind of guidance do they give? And then most important is whether it's bullish or bearish, what does the street do? I've seen stocks just blow the cover off the ball on earnings, come out singing the rosiest guidance you can imagine, and that marked the top in the stock, and it fell from there. That's not always the case, but the important thing is sometimes all that good news is priced into a stock, and then you get a buy the rumor, sell the news kind of thing. So that's it. No sell signals. Trend is bullish right now. I'll be watching for sell signals. And again, the ideal scenario for a short trade will be, of course, a sell signal such as maybe comes in the form of a bearish candlestick reversal pattern like we had back here on SOXX. It's not shown here on XSD. We had an island cluster top, a very high probability, one of my favorite candlestick topping patterns. That marked the top there, and that helped confirm that short trade we had back on the semis then. We might be looking, or we might get some type of bearish candlestick reversal pattern, or maybe an impulsive break below this trend line. That should do the trick. And then if that's the case and it happens soon, then we get a bearish crossover here on the PPO, confirming that divergence. That will help to firm up the case for not just a quick pullback trade, but a swing short trade, a trade that we can hold for at least a couple weeks, maybe even months, depending on how the charts develop. And kind of just a quick look at the weekly, sort of a bigger picture, longer term, where the semis might go, especially if we have some pretty solid evidence of pretty strong top here anytime soon. I think we come back again, visit that 60.26 target. That was my first target before. It was already hit once, and I think if we get there again, which I suspect we will sometime this year, that level will get taken out on the next. Last time we had a successful test of level and a move back up. You could see it was resistance here, support here, successful test. If we come down to it again, probably get a reaction off the initial tag, but ultimately we break and then we come down here to about 45.87 is where I think the semis go in the longer term. Yeah, it's months out. That's about a 50% cut. And it would cut that ETF in half. So this is why I love the semis. You just have to be patient, wait for the right setup. There's another breakout, a little trend line I didn't have marked. Nice divergent low. Again, that they trade well to the technicals. Big bullish falling wedge back here, and you can see all these divergent highs that led to, these are all double-digit corrections after the divergent highs. So we've got one now on the weekly chart. We just need that sell signal, which is not in place at this time. Could come any day now, could come months from now, who knows. SMH, this is the other one. There's a divergent high we had there, and there was a that big correction that we had, about a 16% drop, and we're setting up now again with another dangerously steep trend line. Now this trend line could continue for a long time, or sometimes you break these little trend lines like this. Let's show you a little scenario. I mean, there's a myriad of possibilities. Break it, come in and back test it from below, or set up a secondary trend line. But right now all I can tell you is that we have roughly equal highs when you look at where SMH is, and that's, by the way, the VanEck Vectors Semiconductor ETF. Again, just a different basket with different weightings. Most of the stocks, you'll have a lot of overlap. You'll have most of the key semis in there. Again, just different weightings, and that's why the prices and the charts look different. So that's it. So you have that roughly equal high. Any new marginal high anytime soon will be guaranteed to be a divergent high. Might not be confirmed, but if you turn around and reverse, get the bearish crossover on the weekly, that would be your it will help to confirm that. There it is. You can see the previous reaction high was up here a little bit, right about there. So there it is. So right now you can see divergence on the daily time frame as well on these indicators. Momentum is up to the upside right now. So as I said, it bears repeating. There's nothing even remotely close to a sell signal on the semis at this point in time. But you got to move quick. So now let's run. Oh, there's that island cluster top. It was on SMH right here. See, this is an island cluster. You have a gap on one side, followed by a cluster of candlesticks. There's your gap up. You get a cluster of candlesticks that forms an island, and then you gap down. That is the sell signal, and that was it. It came back tested the island from below, and that's all she wrote. From there the semis dropped about 17%. All right, now let's look at SOXX, and we'll just go through some various time frames. Let's start with the very short term to try to hone in on a possible entry. Here's the last official trade we had on the site. Looks like on May 7th we shorted right here on this trend line break on the semis, and we milked almost all that move down, hitting my third and final target right there at 182.70 with just minimal downside from there. That culminated with a bullish divergent low. There was a trend line here you could see that was taken out, and watch, rinse, repeat stuff as we get out early. And was probably pointed out at the time. There was a nice strong divergent low, trend line break, and that set up this uptrend in the semis. And now it's pretty simple. We've come full circle. So from we had sell signals back here on a trend line break. We got out when we milked most of the run, and now you can see we're setting up here with a fairly well-defined uptrend line on the 60-minute chart. So if you want to really hone in on an entry on a semiconductor short, let's say you don't get a bearish candlestick reversal pattern, 2-3 days of bearish candles, your other sell signal would come on a break, an impulsive break below this bearish rising wedge. There's the negative divergence I like to see to confirm the bearish nature of the wedge, because you have a trend line here forming, and at that point you want to buy pullbacks for the trend line. But at what point does a trend line, at least in my opinion, become something that instead of looking to buy pullbacks to continue to trade the trend, you want to look for a break of? And that is, again, when you see an extended trend coming up to resistance, and most importantly, see that negative divergence which warns that an impending trend change is likely. Not guaranteed, but quite likely. And that was, again, we had that last high right there. We had, of course, a divergent high as well. So that's what it looks like on the 60-minute chart. Let's go back out to the daily chart. Like I said, no sell signals. We don't have a divergent high, and really got to have a way to go on SOXX, but I already showed you XSD has already a divergent high on the daily, and SMH is close to it already, and that's why, again, I like to look at all of these together. Let's go to a weekly chart here. And you can see this sets the stage for, at least in my opinion, when I look at a trade setup, like let's just take that 60-minute chart I just showed you. Usually a 60-minute chart, that's good for a relatively short-term swing trade, because you're trading off a 60-minute time frame. That's a trade that's either going to last normally days or maybe just a few weeks. You go to the daily chart, that sets up a move that might last weeks to months, a typical swing trade. And then when you get to the weekly chart, of course, that paints a much bigger picture there. And you can see SOXX, you can see here, you have these steep uptrend lines, they break, and that leads to these powerful trend reversals. This one was a pretty extended uptrend, ended with nice rising wedge pattern. There's that negative divergence I like to see, and that was a drop in the semis. I'm well into the double digits. I'm just going to ballpark it. I have to grab there, measure down to that low point. That was about a 30% drop in the semis, and it was again foreshadowed by the negative divergence there, and the trend line break was your sell signal. We had a little whipsaw there, but there's enough reactions on that trend line to validate it. Here we had another trend line, nice clean up trend line you can see there. We had a breakdown, and this is a rule if you're new to trading. Sometimes you get trend line breaks and chart pattern breaks, and that's it, and that's your sell signal. Other times, and it's quite, I'd almost be 50-50, especially in a bull market, that you get primary bull market here. That's what we're looking at, that you have a breakdown and then a back test. In this case, that breakdown, it should have been known. You could see we had support right there already. So you broke down. You had some price support. You had this 200-day exponential moving average. See the red line? It's a beautiful EMA. I'll show you here. Let me show you this red line here. It does a great job on a lot of tech sectors and some indexes of acting as support during a bull trend. And you can see right here, support, support, support. Once broken, boom, bearish trend. And then you have, like any other resistance level, a bounce back to resistance is an objective shorting op. And you had that right there, boom, the last leg down. Finally, we recovered the 40-week moving average there, and came back here, overshot it briefly on a momentum-fueled overshoot, and it held so far. So that's a level I'll be watching going forward. I wanted to point that out to you now, in case, if and when we get down to there. That 40-week moving average, this is a weekly chart, so it's a 40-period moving average. That is the same as a 200-day. If you put a 200-day moving average, it'll come in at the same point, because there are 5 days in a week. So if you multiply 40 times 5, you get 200. So that's what you want to have on your daily chart. Let's see what else. So that's it. Like I said, any new high, if it happens to take out the previous high on SOXX, it will almost certainly, anytime soon at least, be just an extension of the existing divergences. You can see the PPO and the RSI are continuing to lag behind price. And here's that minor uptrend line we need to watch right there. Let me go back. Let me go to a daily chart and show you an example. Here we go. This is what I'm talking about. And this is, you can sit here and stroke SOXX all day long, stroke these short trades, watch these trend lines. And the point here is that every one of these corrections, see, they're what I call dangerously steep trend lines. Typically, the more steep a trend line is, the more sharp the correction. But you can see that when the semis break these trend lines, it's quick. You can't wait too long. If you waited just a day in that case, you missed half the move right there. That was, I'm sure, a double digit or close to it. That had to be about a 10% drop. This one would be well over 10%. So again, it's, just watch these trend lines and be ready to jump on them. Sometimes you had this one break. It was a quick move down. We came up, had a steeper trend line. So we had a little kickback rally there, made a marginal new high, then the big correction came. So there it is. A lot of corrections after these trend line breaks. This one you had, initial leg down, kickback rally that failed, and there was a lot more. And there's little zigs and zags along the way, but you can see just how well and how sharp the semis tend to fall after these trend line breaks. And this one, again, we had a breakdown, kickback rally, and then boom, there it was. So this is the trend line I'm watching right now. Bigger picture, where might the semis be going? Because to me, this looks like topping pattern. They've been in a bull market, as the stock market has. You're not going to see the semis in a bear market in tech. And remember, the stock market, Even the S&P 500, which is much, much, much more diversified than the NASDAQ 100. The NASDAQ 100 is 60% roughly tech stocks, doesn't have any financials in there, it lacks a lot of things, utilities, steady eddy, dividend paying stocks. It's really a tech heavy index. However, even the S&P 500, which is much more representative of the whole economy and the whole stock market, is still by far the largest component of that is tech. These tech behemoths, Apple, Microsoft, Amazon, they've taken over. They are the bulk of the stock market. A good part of it, I should say, is in those tech names. And so you're not going to see the semis, in other words, are going to move with the market, give or take. They can do their own thing at times, but we've been in a cyclical or secular bull market, I should say, longer term since 2009. And now this to me looks pretty toppy. The last time we had negative divergence on the weekly time frame, well, we had it back here. That was that big drop. I told you about 30%. We had it right here. Comparable drop right there. That was all laid out in advance here. That was a drop of about, another about 30% drop. And unlike this time around, see what happened there is we powered on through and we went on. We had a new uptrend. This time around, the divergence has continued to build. And so what this is telling me, as long as these long-term, these are weekly divergences, as long as they're still intact, that sets the stage for a much larger correction. These divergences triggered a 30% drop. This is a much longer divergence. It's been building now for a year and a half, almost 2 years. If and when it plays out, I would expect to move down to, see this 170 level again, that 144.20 level, and ultimately I think SOXX is coming down to here at 102.30. And that would be a drop from where we're at today. Again, we don't have any signs of the top yet, or at least the next sell signal. But again, it's about a 50% drop, and that meshes with what I think I told you on XSD a minute ago. And so, I imagine most won't swing trade that. The counter trend rallies are going to be very powerful, and what I tend to do is I'll micromanage a trade. When we finally start to see evidence that the market's rolled over in these semis, there'll be plenty of long ops along the way. Opportunities to reverse a short position that you're trend trading down, and game a bounce here. It might be 10, 20. That's the beautiful thing about trading bear markets. We haven't seen one in over a decade now. At least on the stock market. But the beautiful thing, and where I love to trade them, is the counter trend rallies. Nothing is as powerful as a bear market rally. Stocks can shoot up very fast and very strong because you have the added short covering in there. And again, that's what a longer term trade might look like. Now, you can also, if you're not an active trader and you finally get some sell signals, the next time we have a sell signal on SOX, if you believe that might be the top, then what you do at that point is you take a position and you're planning to hold for that 50% or so drop, if that's what you agree with. And what you do, it's simple. You just trail your stops down. Once the trade starts to pan out, you have an initial stop up here somewhere above your entry, and then you lower, let's say when you hit this 170 target, at that point maybe lower a little bit above this 189 support. You give yourself enough room to stay in that trade, and gradually just lower stops along the way, knowing that if you put a 5 or 4% or even an 8% trailing stop on the semiconductors and you're trying to trend trade, you're trying to swing for a 50% gain, I promise you they will take your shares away from you. The kickback rallies in this will be much bigger than 4 or 5, even 8%. So you just have to keep that in mind. And again, there's many ways to trade. If you're not comfortable with a 15, 20% stop loss, you're not going to swing trade from here down to 50% because there's going to be those kickback rallies along the way. And that's also fine. That's why on the trade ideas I always list multiple targets. Those are areas where you're likely to get a reaction, and then you can either cover or tighten stops down to that point. Let's say when the first target's hit, so maybe we don't get the reaction, or it's maybe only a consolidation, then we move on down to the second target. That keeps you in the trade, so you're locking in or at least protecting your profits and letting your winners run, because that's the key to investing. It's rule number 101: cut your losers and let your winners run. It's really that simple. Easier said than done, but that's simple. And finally, this is a monthly chart. You want to look back, going back, and again, this is just the ETF here. This goes back to about 2001, And what we're looking at, here's your, secular bull market right here in the semis off the 2008 lows. The semis, and the only other thing, at least the only index that bottomed back in 2008 in November, was the NASDAQ 100. Every other index, the Dow, the SPY, small caps, mid caps, you name it, they all bottomed in March '09. And this shows you that semis are tech. The semis will lead. These are the canary in the coal mine for the tech sector, is semiconductor. So I'll watch these closely. And again, you can see there's all the the trends within bull and bear markets. You get these uptrend lines, and you get a breakdown. Sometimes you get a back test, and that's where your corrections come. So you can see again that the semis tend to trade in those pretty clear trends, and these are smaller trends within the larger uptrend here, which is defined by this trend line. So if the bearish scenario, and you can see all the way out here, now we haven't had negative divergence throughout this entire bull market. We have not had negative divergence on the monthly time frame until now. And again, this kind of meshes with everything. We know we are in the late stage of the longest economic expansion in history, the longest bull market ever. So, mean reversions, there's a lot of things, and there's reasons why you have to have those mean reversions. I won't get into it, get off topic, but there's reasons why you can't expand an economy indefinitely, why recessions are a must. The analogy I like to use are prescribed burns. I live in Florida. You guys in California probably have them. Anywhere where it's dry, the forestry department comes in and they burn down the undergrowth, the dead scrub, dead trees, so you don't have those huge fires that wipe everything out. And so that's what a recession is, and that's what the Fed has done here by prolonging, with these uber easy money rates, prolonging the business cycle and not letting a recession happen. They're setting the stage for a much bigger drop when it finally does come, and something they won't be able to stop. Just like not doing those prescribed burns for 50, 100 years, and that lightning strike hits, or the camper doesn't put his campfire out, you're going to burn the whole forest down instead of just having a more manageable fire. And that's what happens in the economy as well. So that's it. Negative divergence, as you can see, all the way out to the monthly time frame. And this, you're not going to have buy and sell signals here that are going to time a swing trade, but longer term trades, yes. And you can see on the monthly chart, we had a huge, we haven't seen this. I don't know, might have to go back into the .com days. A huge bearish engulfing candle that happened back in the month of May, ending in May. It wiped out the previous candles right here. That's what a bearish engulfing, when the body of the candle, big red candle, engulfs the body of the previous candles, and that's what happened there. And we're getting pushing to the top of that. And this is why really, to keep that sell signal intact, it's not an all or none, but to keep that sell signal intact, you want to see this month close below the top of that May bearish engulfing candle. So that's something I'll be watching for. We're starting to push up there, but we haven't taken it out yet. And that's just all the better why it would fit if Intel craps out on Friday, sets the tone for the semis, and we start to correct. It would certainly mesh well with this scenario that that was a major topping stick. This is just a kickback rally, and the next leg down to come. And then, of course, if and when we get there, we'll watch that long-term primary bull market uptrend line. When that's broken, that will help increase the odds of that, sharply increase the odds of that 50% correction that I'm looking for. Okay, and let's wrap the video up just going in reverse. I just loaded the SOXX. This is the index itself. Now you can see I can go back into the 90s because that index has been around before the advent of ETFs. And again, so you can see all the trend lines. These are the trends you trade. And there's that primary uptrend line off the 2008 lows. That's what we're watching. There's the clean negative divergence against something that we haven't seen. Even going back to that .com bubble, we didn't even have the divergence there. So this is a pretty powerful stuff to get negative divergence on a monthly time frame. That tells me that the semis, I'm looking for correction that's probably going to last years, not months, but years, and wipe out, as I said, before all said and done. Again, no sell signals yet, but when we get it, about a 50, chop the sector in half, about a 50% drop. Go down to the weekly chart. Most of what I just showed you on SOXX, because again, this is the index that ETF is tracking. Oh, and guys, by the way, if I didn't make it clear in the beginning, I said I like to watch this trade SOXX because it tracks this index, which has been around, the original semiconductor index. But it is also for those of you that like the leverage ETFs, SOXL and SOXX. They give you the maximum juice. They're 3-time leverage ETFs. They also track the exact same index, the SOXX, that SOXX does. So therefore, I get a lot of questions. Hey, somebody wants to short this. It takes a lot of time to put up charts. I can't put up infinite number of charts because there are almost an infinite number of different ETFs for every sector. There's, some sectors have multiple, like this one. This one has at least 3 one-time ETFs, then it has quite a few 2- and 3-time leverage ETFs. But if you like the leverage, let's say, for example, you want to short in your IRAs where you can't normally short, but you can buy a short ETF. This is what we'd look at here. So there's SOXX, not something you want to hold for long term. The decay is vicious because the semis are very volatile. However, these moves, and it may not look like much, you get in the right move. I told you, remember, that was an 18% drop that last time we shorted, 17% drop in the semis. We call it the bulk of the move, but you can see there 85%. I talk about this very often. It's explained in the FAQ page, which can be found under resources on the main menu, that these things get a very bad rap, as they should, when people buy and tuck away a leverage ETF for a long period of time. The decay will eat you alive. You will lose all your money, hold it long enough. You can see that's dropped 99.28% since this thing came out back here. Actually, go back to where it came out. If you bought it and tucked it away, it'll approach 100%. It can never hit 100%, but it'll approach it. So that's almost, you can see the pop-up box, 99.97%. This is why you don't hold these. But for a tactical trade, strategic trade, you get in at the right time. And again, instead of making 17% times 3, what would that be, 45, 50% or so, somewhere give or take, you made 85. You did much better than 300%. Why? Because this is what I talk about in the FAQ page. It was a unidirectional drop, a nearly straight down drop, a strong correction, and that's what this thing does. Therefore, I'll not mix words here. I like using, SOX. I will prefer to use, I would rather have, X amount of the, if I'm going to short the semis in an IRA, I'd rather have, 1 unit of SOXX versus, you can't short an IRA, but there's, 3 times as much SOXX if I suspect one of those strong drops. And that's usually how the semis break down. You just got to get the timing right. And if you get it wrong, sometimes I'll jump the gun too on a trade. You recognize that you were wrong when the chart's no longer confirmed and get out. Don't hold on to SOXX or SOXL, the leverage ETFs. Or hell, don't hold, for that matter, don't hold on to the one time because you can get eaten alive. The semis move a lot. All right, so back to the index and then we'll wrap up here. We're almost done. All right, there's the Philex. I showed you the weekly charts, really no different than what I had on the SOXX ETF. Here's the daily chart of the index itself, and you can see here there are some periods where the semis kind of consolidate and grind around for a while, but for the most part, as these trend lines show you, look for these steep uptrend lines, and then boom, you get those shorts. This one you broke down and you back tested and you had another steep uptrend line and then the big correction there. So it's not always easy, and that's why, for example, you shorted that breakdown and maybe it hit your target back then. Maybe it fell shy in reverse, but you don't fall in love with the trade. You use stops, and you're going to win some, lose some. But every now and then you're going to catch a runner trade, like this one, where you get the bulk of a nice run like that, or maybe even the much bigger when the top comes, the top on this sector. Like I said, there's as much as, I believe, 50% downside in the sector. So that's that. Okay, no reason to go down to the 60-minute. I already gave you the 60-minute chart. I started out early and showed you that on SOXX to kind of maybe give you an early heads up if this trend line breaks. And I haven't laid out targets yet because I will. I plan to add this as an official trade, probably add it as a setup first. But I'd really like to wait and let Intel get out of the way. Like I said in the beginning of the video, I said it many times over, the trend right now is bullish with zero sell signals. Yes, we have divergences. Yes, we have some overbought conditions, but neither of those are sell signals. Divergences, overbought, are merely, hey, an indication that, hey, things are getting ahead of itself, probably going to get a correction soon, but that could continue for some time, the current trend. So this is what I'll be looking for, as well as any potential bearish reversal patterns. And I'd like to again see what Intel does. In the next video, I will go over the individual semiconductor stocks, and I'll cover Intel, which I've covered quite a bit since last year. Before this bearish rising wedge even broke down, had my targets. First one's already been hit. I still think we come down here to the second target, and so we'll watch this one closely. And again, I'll follow up if I decide to add it as an official trade even before Intel reports. I might put out some targets and other levels, and I can do that as a trade setup. And a trade setup is a potential trade pending an entry or a trigger, a buy or sell trigger. And if anything, that's what I would pass along SOXX as before Intel reports. And then maybe next week or even on Friday, maybe jump into that trade if we get an objective entry and a sell signal. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.